Let's turn now to Microsoft, closing slightly lower today after getting a rare downgrade from D.A. Davidson to neutral from buy as AI competition heats up. Well, joining us now is the man behind that note, Gil Luria from D.A. Davidson. Gil, it's good to have you on. Why downgrade Microsoft now?
Well, Microsoft has done phenomenally well in the last 12 to 18 months. And the reason is that they took that big lead in the AI market. They were early in on OpenAI. They commercialized products early. And that's why last year they accelerated the growth at Azure faster than any of the other hyperscalers. Unfortunately for them, that narrative is still in place. People still believe that they have a huge lead over AWS and Google Cloud, when our observation is that that's not the case any longer. AWS is now adding as much business as Microsoft is in Azure. Google Cloud is growing the same on a percentage basis. And importantly, going forward, Google and Amazon have done a better job of investing in their own chips, and they have a lot more availability of their own chips, which makes their service, gives them a cost advantage over Microsoft going forward.
So, Gil, it occurs to me that if the others caught up that quick, then Microsoft didn't really have a big lead to begin with. I mean, maybe they came out with something faster. Maybe they were tied up with OpenAI, which was prescient. But is that your argument, in essence? Maybe that as Amazon and Google were saying from the beginning, they don't have this big lead that maybe Microsoft didn't?
Well, the lead closed quickly because this is such an important market that these companies are going to put as much capital and internal investment as they need to win in this market. And that's what happened at Amazon. They changed personnel, they invested, they're increasing their investment. And fortunately for them, they already had investments in their own semiconductors. So did Google. Google actually had, as we know, the technology in-house to begin with. They just commercialized it a little slowly. But as the urgency came in with Sergey Brin, with red flags coming in a year ago, they were able to invest as much as they needed to close the gap.
Brace yourself, stock market enthusiasts. The world of finance and technology has just been shaken by a seismic shift, sending ripples across Wall Street. In an unexpected twist, D.A. Davidson's analyst Gil Luria has downgraded Microsoft Corp, a titan in the tech industry, from a buy to a neutral rating, despite maintaining a bullish price target of $475. This eye-opening assessment hinges on the fierce competition roaring through the artificial intelligence realm and Microsoft's internal strategic maneuvers. It's a development that sets the stage for a riveting market narrative, filled with excitement, intrigue, and an uncertain path forward in the world of tech stocks. Welcome back, everyone, to Investocracy.
So when it comes to Microsoft, can they really show up in anything that will set their earnings, set their share price higher, or do all we care about is what they're doing with AI?
I think that's where the focus has got to be. Look, there's a read across from Alphabet for Microsoft and two lines that tie in from Alphabet to Microsoft. One is on the cloud business. Alphabet performed well on that front. Expectations are that Microsoft is going to come through with growth of about 30% for cloud and for Azure. So watch for that. The other line that you can tie and link from Alphabet to Microsoft is the CapEx, the spending on that AI infrastructure. And that's where the concern was for investors in Alphabet last week, despite the top line beat on the earnings story there. Microsoft expected to ramp up its spending from about $11 billion to $13.3 billion. Anything above that could cause jitters. Analysts telling Bloomberg, look, inline earnings, inline results for companies like Microsoft, not good enough. They're not going to be good enough for investors out there. They need to come through with a solid beat. So watch cloud and watch the spend on CapEx around AI.
Ladies and gentlemen, today we delve deep into an intricate tale of formidable struggle and innovative rivalry that perfectly encapsulates the spirited competition of the stock market. Gil Luria's recent downgrade of Microsoft sheds light on a story not merely of financial numbers, but of a grand battle unfolding in the fast-paced arenas of AI and cloud computing. The narrative unfolds like an unexpected plot twist in a blockbuster movie. Microsoft, once the unchallenged leader and the unyielding colossus of the tech world, now finds itself amid a compelling race for superiority. And no, this isn't the latest episode of Silicon Valley, but it might as well be for its drama and high stakes. Our journey through the legend of Microsoft's rapid ascent begins with the company's early, visionary investment in OpenAI, Aligning with this cutting-edge AI entity propelled Microsoft to extraordinary heights of success, enabling them to integrate groundbreaking AI functionalities within Azure and GitHub services. Microsoft's advancements allowed them to surge ahead of competitors like Amazon's AWS and Google's GCP, securing an enviable lead in a fiercely contested market. It was akin to watching your favorite sports team score a series of last-minute game-winning goals over and over again. However, fast forward to the present day, and the storyline pivots dramatically. According to Luria's insightful analysis, the rapid pace at which Amazon and Google have closed the gap now casts shadows over Microsoft's premium valuation, making it a contentious point. Picture a marathon runner who leads the pack for most of the race, only to find her rivals shoulder to shoulder as the finish line looms in sight. As impressive as Microsoft's technological advances have been, AWS and Google Cloud Platform have dramatically accelerated their own progress. But before we go any further, if you want to keep up with Microsoft's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market. So click the follow button if you don't want to miss the newest market updates. That said, back to the video.
Microsoft earnings, I just mentioned, they're out. Steve Kovac has the numbers.
Hey, Morgan, I was reading your mind here. It is a beat on the top and bottom lines here. Let me go over what we got. EPS coming in at $2.95. Street was looking for $2.93. Revenue, just a slight beat here, $64.7 billion. Street was looking for $64.39 billion. And then Azure cloud growth, as you know, super important. That did miss expectations here. Street was looking for 30.2%, but they printed here 29%. Azure revenue growth. I'm going to keep digging through these numbers and come back with some more commentary for you guys. Especially important how much of that Azure cloud growth was related to artificial intelligence. I'll be right back with you guys on that. Back to you.
Okay, and we will come back to you as soon as you have more to bring us. So, Kevin, yes. I mean, right there, you've got shares of Microsoft now down more than 7%, largely on this Azure cloud miss. I mean, 29% represents a deceleration in the growth that was starting to perk up in recent quarters.
It's a slight miss on their Azure revenue growth. But what I will point out is investors need to remember that the AI CapEx spending game is a long game, and it may be years before we start to realize the benefits of all those investments. Microsoft was very early to the game. They continue to spend in the areas of AI. I think there's work to be done on the Copilot side. They have to address security concerns. They have to address a higher price point. But Cloud Azure is going to be their revenue for growth potential for years to come.
Delving deeper into the analysis, consider the proprietary hyperscaler semiconductor report, where AWS and GCP have outshone Azure in incorporating silicon into their data centers. It's reminiscent of a high-octane Formula One race where a seemingly invincible leader finds their rivals upgrading to more powerful engines mid-race. Amazon's semiconductor capabilities, vastly more potent, starkly contrast Microsoft's emerging endeavors with their Maya chips, which lag in both development and deployment. This shift also necessitates a steep increase in capital expenditure, visibly reflected in a significant decline in operating margins. For some perspective, Microsoft's data center CapEx is projected to surge from 12% to 21% of their revenue. This is a stark contrast to Amazon and Google, whose increases remain more measured and controlled. It's akin to Microsoft needing to procure premium, high-octane fuel to sustain its cloud engine while its competitors optimize their engines to run efficiently on more economical resources. As this frenzied technological arms race continues, layoffs become an unsavory reality for balancing financial constraints. To counterbalance these margin dips, Microsoft might find itself compelled to let go of approximately 10,000 employees annually, a sobering consequence of overinvestment and competitive pressures. Meanwhile, the GitHub narrative introduces another fascinating dimension to our saga. Microsoft's GitHub Copilot, once heralded as the beacon of AI-driven code generation, now encounters formidable challengers like Amazon, GitLab, and the emerging contender, Cursor. This scenario echoes the dramatic power struggles akin to Game of Thrones, where the current ruler is incessantly challenged by multiple aspirants vying for dominance. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Okay, Paul, this is traditionally a difficult quarter for Microsoft. If you're just looking at the quarter itself, also the end of the fiscal year, and we're going to get more sense of the guidance on the call. So, I mean, how much does this Azure, you can call it a miss, because certainly the whispers and the hopes were higher. Can AI assuage any of that, or is it perhaps proof that AI can't do everything?
Yeah, I mean, I think, John, what you said is the key point is this quarter is usually a weak quarter for Microsoft in terms of its earnings and its stock price reaction. It's historically weak in reaction to this July report. Last quarter, Azure was stronger than expected. Stock rallied. So this quarter, we're seeing the opposite and the stock's falling. What I think is really interesting that you mentioned AI is ever since the launch of, from 2001 up until ChatGPT was launched, Microsoft, when it reported earnings, had an average move of about 1 to 2% up plus or minus in reaction to its report. Since ChatGPT, the last 6 quarters, I believe it is, its average move is plus or minus 10% or 12%. So it's become very volatile in reaction to earnings during these periods. But the overall trend for the stock has been up. It's just the short term, the market gets ultra focused on the smallest beat or gain because there's just so much focus on the cloud and AI here.
So, what conclusions can we draw for Microsoft, and more intriguingly, for the astute investors assessing the stock market landscape? Although Microsoft's stock has seen substantial growth, the freshly analyzed competitive environment urges a recalibration of expectations. Even with its fresh downgrade, Microsoft persists as a formidable presence with a robust foundational structure. As it stands, Microsoft trades with resilience and caution, vigilantly monitoring its rivals' maneuvers. Future forecasts suggest a trajectory of steady, if not spectacular, growth, heavily predicated on its strategic ventures and investments in AI and cloud technologies. In the volatile world of stock markets, holding on to Microsoft might be analogous to keeping a wild card in your hand. It's unpredictable yet brimming with potential rewards. And now, the million-dollar question, pun very much intended, will you, dear investor, choose to ride the turbulent waves alongside Microsoft in this exhilarating race? Or would you diversify towards emerging rivals? Let's spark a conversation. What are your thoughts on this dynamic AI-driven cloud competition? Share your insights, and together we can navigate this intricate stock market labyrinth. And finally, if you would like to know what companies like Microsoft have been up to these past few days, go ahead and click on the next video on your screen. See you there.